Okay.
And we're live.
We're live.
Look at that.
Awesome. All right. Anybody tuning in? This is the Tabs 2 Cents pitch deck. Got my friend here, Simon Handrahan. We're going to go over some stocks that, could be our next purchase and kind of talk it out with each other. I'm more of a top-down guy. He's sort of a bottom-up guy. So we sort of just figure it out together and maybe complement each other's styles and see how that works. So so before we get started, Simon, if you want to just introduce yourself.
Thanks, Joe. It's fun to be back. Looking forward to it today, and we're just going to talk about a couple ideas. I know, like Joe mentioned, I'm probably more of a bottom-up stock picker that way. Most of my focus is on high-quality names. Sometimes I'll go into the microcap names as well, and I always enjoy talking to Joe because he's really focused on the big picture, macro, secular trends, and things like that. So it's always fun to bounce ideas and hear a different perspective.
Yeah, absolutely. So that said, I'll go first. Simon was on a space not too long ago, and we sort of were discussing our different styles. And what I've sort of adopted as a style for me is I don't feel comfortable necessarily picking winners, and it's kind of difficult, I think. And I do hold some individual stocks myself, but what I like to do is just get sector-based ETFs and try to ride the wave of sectors that I think are going to outperform with a well-done ETF. So what I'm going to bring to the table today is the iShares US Healthcare ETF. And so this is ticker IYH. So that's India Yankee Hotel. And this stock closed today. It's what's the date today? It's July 27th. Closed today at $283 US. So, we were joking earlier. I mentioned it to Simon. I said this maybe isn't a stock that you're gonna buy a ton of, but it doesn't matter because it's an ETF and it has a whole bunch of holdings. I think we've got it right here. The holdings for this stock, there's 121. So you don't necessarily need to buy too many. If you can afford one, that's great. You're going to get 121 U.S. healthcare companies. And this company, this ETF, just a couple of key facts before we get into why I like it. And of course, this is nothing we say here is investment or financial advice. We're just more for entertainment and just for knowledge and shooting ideas back and forth. Yep. So this ETF, it comes with an expense ratio of 0.39. So pretty low when you consider, your typical mutual fund is going to be like 2% or something like that. So you get 0.39 and you get the advantages of holding a large portion of U.S. healthcare stocks. And one of the reasons that, I like this space is because we're sort of seeing an aging population, and as people start to age in the U.S., they're probably going to need some more help. So if you buy an ETF like this, you're going to get exposure to lots of things. You're getting exposure to health insurance. You're going to get an exposure to drugs. You're going to get exposure to medical equipment. Like I know you mentioned that you hold Thermo Fisher.
Yeah, Thermo Fisher is
which is
kind of picks and shovels type play in the industry.
Yeah, which is, I know I've seen a lot of talk about Thermo Fisher kind of on FinTwit and stuff. So you get all those things, and for me, you look at the median age in the U.S. in 2022, it's at 38.9, and that's up from 37.2 in 2010, 30 in 1980, and 28.1 in 1970. So it's clearly people are getting older and they're going to need more help, and also the obesity rates are going up, and this is one of those things that we kind of discussed a little bit before the show. You have to sort of be comfortable with different aspects. Like the medical team is helping people, but then of course you're benefiting off people being sick, and what I would like mostly is for everybody to just exercise and eat better and whatever. But with Instagram and social media and all the things that are happening, not everybody gets exercise and gets outside. So that's kind of one of the aspects of health that's happening lately, and I mean, it is what it is. So maybe these healthcare companies can help them in their journey to get healthier. So that's one thing I was talking about. It's a lot of these companies, like I've just got the top 10 holdings here. You got United Health Group, you got Johnson & Johnson, Eli Lilly, you got Merck, you got AbbVie, and you got Pfizer in here too, which for me is interesting because in the COVID pandemic, something we saw with health and technology is the breakthrough of the RMNA vaccine. And it's what I found interesting about that is that America did it first, right? And they were kind of, I guess it was like America and Germany sort of together.
Yeah.
But I have to think that if that technology is going to move further, it's probably going to be American companies that sort of make the next breakthroughs. And then if that's the case, then, you can get it, you'll probably get exposure to one of those companies in this ETF. So you're sort of banking on the American innovation in the healthcare space.
Is it fair to say that a lot of these, Joe, are like American companies in terms of listing and headquarters, but really they're global?
Yeah,
companies?
for sure.
Yeah.
For sure. But I think their base is in the States, and they kind of develop and do most of their work in the US, and then branch out that technology across the world. I think I have to dig deeper on that.
I guess it depends, but yeah, a lot of the big ones are probably that way.
Yeah, and they probably do work together with a lot of different places and have, research hubs in like Germany and whatever. So it's kind of I suppose you could look at it as a global play on healthcare with US companies as well. So
I think that's fair. Yeah.
Mm-hmm. And I think a lot of these trends that you're seeing in the US are also kind of worldwide. I know Japan right now is going through a huge crisis with aging, and they don't have anybody new. And then, China's having I think they had fewer, like a shrinking population for the first time, however long.
I think that's true. Yeah.
Due to not enough babies. So it's kind of it's sort of a global thing. So yeah, I don't know. That's what I've got. What do you think about it?
Yeah, I like the idea. It's hard to say that there wouldn't be like a secular, trend in the right direction for a lot of these businesses, I would think. And at least the big ones are definitely like dominant players in the industry. Because of that, I'd be curious to do some kind of analysis on how much growth is already kind of baked in, and how much of these big dominant players are kind of saturated to some extent. I think that's a concern of mine with most businesses that are above 100 million, and they might be global, but how much are they really going to grow from there? The base rate of trillion-dollar businesses is pretty low, so that would be one thing I would be concerned about. I was wondering, the other thing, just off the top of my head, was also about if there's regulatory concerns. So I think a lot of these companies actually probably benefit from regulatory regimes where it's tougher for new entrants, for instance, to enter.
Yeah.
But I wonder at some point if they get so big that there might even be some pressure from antitrust type. I don't know. And I'm sure it doesn't apply to every business that's on that list. So just off the top of my head, those would be the two things that I would be looking into perhaps to understand. I think the other thing that comes to mind when I think about some of these healthcare with the drug makers, perhaps more than the others, is some of them can be a little bit speculative. Probably some of the smaller ones, maybe a little bit more so, where they're, relying on getting drug testing past regulators, the FDA, et cetera. That's something that I've always kind of stayed away from for that reason, but probably, the Johnsons and Johnsons and Mercks and these bigger ones, that's less of a concern. They've got a diverse business that way, so perhaps less of a concern. But the smaller ones, I'd want to know how much exposure do I have to that type of risk, where it's this kind of single point vulnerability for the business model, perhaps.
Yeah, it's interesting you mentioned that, because when I was looking through these stocks, we take United Health for example, I sort of expected to see a bigger dividend, and I expected to see a lower PE. And what you're getting here is 22 PE, which is okay, but then the yield you're getting is 1.3, and I'm like, this is a healthcare reoccurring revenue.
Right.
Why is the dividend so low? And it's kind of a you
I
know,
guess like do they actually pay out a lot of their cash in dividends, or do they reinvest it? Do they buy back stock? But that would be something to look
Yeah.
into as well.
Yeah, definitely. And this is like just like on the surface,
Yeah.
you know, for now. But that's a good point. They could do stock buybacks, or they could do special dividends. And
Yeah.
they could dump it back into research, which maybe they have to stay ahead of the game.
Right.
So
Yeah, it'd be interesting to see like how many of these companies really need to like reinvest in their their R&D segments to fund that growth. Like that would be one thing to consider. The other thing I was wondering is like because you're buying basically an entire sector, is there any like historical data on how that sector has performed? I think that the healthcare sector in the U.S. in particular has actually performed quite well relative to other sectors. Now you might want to look at like how mature that industry is now compared to history. So if we're at a point where we're kind of saturated and the how good those businesses are is more well understood now, maybe that's gonna look like the future is not quite as good as it was historically. But I believe that the healthcare as a sector has performed quite well. So that would be one thing I would consider as well. I don't know how cyclical some of these businesses are. I would suspect they're not. Like I think they're, for the most part, more resilient to economic cycles. But that would be the other thing to really understand. So like, if you're buying something that's less exposed to the downturns, they're more steady, resilient businesses, then paying a 20 PE or higher is probably, depending on how much they invest and how much growth they expect. That kind of gives you a sign of like, well, is that a fair price or not? Without having to dig down into each business. If you can somehow get a reasonable understanding of some kind of median or average, that might help.
Yeah, and if this was just like from your perspective, if you had this idea that I've kind of concocted in my mind,
right?
People are getting older, they're getting fatter, they're getting sicker. Like, would you dive into an ETF like this and find the best company, do you think? Or would you buy the sector? Or would
I think if it were me, I would have to narrow down the list in terms of like what businesses I actually understand, because I think if you're going to hold an individual business, like the psychological impact of down cycles and things makes you think differently than if you're holding a broad basket like an ETF.
Yeah.
So then that would probably eliminate 95% of the names in the list, I would think.
Yeah.
And I'd go from there, and I'd try to find, maybe a couple that are reasonably priced with good prospects going forward that line up with like your big picture thesis of what's going to happen with the sector, right? So that's probably how I would approach it. The Thermo Fisher, like I own it because like it's I do think you're right. Like there's a lot of secular tailwinds in the sector's favor. So that's one that I think I can understand and appreciate what they do a little more than most. So that's where and their management is pretty top notch as well. They've demonstrated, they are able to reinvest at really attractive rates of return. So
yeah, one thing I wonder about these companies, and like Thermo Fisher is one that would have a huge moat because like they make medical equipment, right?
Yeah.
So it's like not
something easy to get into.
Yeah, like nobody can do that. And it's like other than they're very specific, and not to mention getting the contracts and all those things, right? So I do wonder, like with drug makers and some of these, I mean, they're major conglomerates, so like they do everything.
Yeah,
but like,
broad, yeah.
I wonder if there's any chance of smaller, kind of innovative companies, like we saw what happened with Moderna, right? Moderna was a pretty small company, and they came out with their vaccine, and they were selling as many as Pfizer, which was, kind of unheard of. So I do wonder if there's a potential for a little bit of infiltration from smaller companies with these big guys. But at the same time, I sort of feel like it'll be minor. Big guys will see what they're doing and they'll sort of copy and take it.
I don't think I wouldn't extrapolate too much from like the COVID experience. I don't think.
It was definitely kind of weird.
Yeah.
Just a good example of what can happen.
Yeah, I suppose in individual cases that could happen. I don't think that it's as likely when you talk about like, upending a Johnson & Johnson. Most of their business is not something that's just going to be disrupted
Yeah.
I don't think. Maybe that's not the best example because they're pretty broad. So like individual business units, maybe they could be disruptive.
I do think that they were assisted, and anybody can correct me if I'm wrong, but I do think because Moderna was close, they got a lot of government funding,
Right.
which wouldn't happen.
But
otherwise.
normally that wouldn't happen because
Yeah.
there wouldn't be this urgency to just shove money in and
Exactly.
get to the final product as soon as possible.
So that was maybe more of a black swan. They just kind of like, you're not going to get that kind of funding unless you're in a pandemic.
Yeah.
So it's like maybe most of the time the big guys have the best drugs. So it's really an argument for.
I don't know. Yeah, I also don't know.
Yeah. But yeah, it's good to kind of just hash it out.
Interesting. Yeah.
But yeah, something to think about. But yeah, I think that was, it's interesting. And
have you? I guess the other thing I would look about the sector, I believe you that there's like a kind of a tailwind there. But have you looked into like what is like the percentage of disposable income people, like this kind of discretionary healthcare purchases? That might be a good trend. I think that ties into like your Instagram and your mental health trends and things like that as well.
Yeah, like how much are they spending on what things? And yeah.
Cosmetic surgeries and
those are definitely that's an upcoming. I don't know how much exposure these guys have.
Be curious how much like of the middle class or the working class or whatever you want to call it, like how much of that has shifted down from this is only something like super rich people do and it's becoming like more and more normalized with everyday people.
I think that's a good point to consider because we're getting older, but at the same time the inequality gap is getting larger. So maybe even though they're old, people are older in different parts of the world, they might not be able to afford the treatments, as sad as it is.
Yeah.
So it's not gonna.
Yeah, that could be one thing. What I was suggesting is that like the more kind of optional type purchases are actually becoming more accessible for more people.
Yeah, that's possible too.
Maybe that's a Western world thing. I'm not sure, but
there is like, I know in medical stuff, like there is sort of a massive like trickle down of technology.
Yeah.
So like a drug that was super expensive like 10 years ago is like super cheap now.
Yeah.
So that's
part of it. Maybe.
Pros and cons.
Yeah.
As well. Yeah, that's definitely some stuff I'll have to consider and maybe look into a little bit further.
Yeah.
What'd you bring to the table today?
Yeah. So I brought an individual name. So I've owned this for a couple of years now. It's Alimentation Couche-Tard. It's a French company out of Quebec. Most people would probably recognize the brand name as Circle K. They are basically a global operator and owner of gas stations and convenience stations. Like founded in the 90s, they really grew a lot by acquisition in the 2000s. Right now, they're $62 billion Canadian market cap, about 70 billion in enterprise value, so a little bit of debt as well. They do about 72 billion, give or take a couple billion every year in the most recent year. And they've been really steady growers. Not hyper growth by any means. Obviously, it's kind of a boring, kind of mature industry for sure. But historically, like the industry's been very fragmented. You get a lot of mom and pops, you get like regional chains, local kind of owners that way. And because of that, they've really been excellent. One, they've been excellent operators, so they're very cost focused. They're very like innovative in terms of what they offer the customer. Very focused on the customer experience that way. So they're very shrewd operators that way, and then they've been able to take those profits and then like the 2000s, the 2010s, especially the early 2010s, they have done a lot of acquisitions to grow. So right now they're up to about over 14,000 stores globally, and a few thousand of those they license, but most of them they operate. They operate in the US, in Canada, and in Europe, and now they're trying to enter Asia as well. So they're really turning into a global player. About 2/3 of their stores are US, 20% in Europe, and something like 13% in Canada. So a lot of people, in Canada and the US would recognize the Circle K branding at their local stores. Really, they've been very good at being able to like do acquisitions, like I said, with their profits, and then in the last few years they've shifted their focus a little bit. They haven't really done as many acquisitions as they have historically. Partly that's because of size. So, doing an acquisition is a little bit more difficult in terms of like moving the needle. But also recently, like the prices for these assets have been a lot higher, so they haven't been able to do. They're pretty committed to doing like value added capital allocation. So they're not just going to go and waste money on acquisitions just for the sake of growing their top line. They've been pretty shrewd at growing their. I think they've grown their dividend like 27% a year for the last decade or so.
Solid.
Not bad.
Solid.
Not bad, right? I know their revenue has basically been growing mid single digits to low double digits in the last decade, and then previous to that, they've had a higher growth, but now they've kind of matured. Their revenue growth has slowed down a little bit, but in the last few years, they're really focused on like organic growth. So as an example, they've been offering a lot of different like loyalty programs and certain things. They've been testing things out like that. To really incentivize, repeat business with customers, stronger brand. They really want to become like the desired choice for local customers. So like what they're after is offering a better experience. So part of that was, like I mentioned, just trying different loyalty programs, discount memberships, things like that. They've been adding like things like car washes. So they've been purchasing car washes. They'll renovate stores where it makes sense. So they've been pretty good at identifying those opportunities, and they've even historically been pretty good at like selling assets that don't have good returns. So like poor operational assets they've just sold off as an example. So they're pretty good at allocating, focusing the resources on value added approaches. The other thing I'd mention. What I was going to mention was about the in terms of like offering a better service. A couple of interesting things they've started to do. We call it like fresh food now. So really just offering, instead of just like packaged snack food, tobacco, liquor, that kind of things. They've also like expanded to offering like breakfast sandwiches, pizza, these kinds of things, fresh baked goods items, like things like that, and even like fresh fruit and things like that. Sandwiches, and that's actually been pretty successful everywhere they've tried it. So they're ramping that up pretty well. And I know that in the last few years they've also been a little better at like identifying specific pricing. So in certain stores, they'll adjust pricing based on the customer need and the customer demand, and that's been helped by like better data essentially. So it's funny, like you get this old business, basically like convenience stores and gas stores, and they've actually been beneficiaries of a lot of kind of technology, better logistics, all that kind of thing. So when you look at like earnings per share growth, it's grown at I think 10% or so over the last decade, maybe even a little bit more than that. But revenue is actually only growing like 6 to 8%, something like that. So part of that is like margins have just been increasing. They've been like identifying how to manage cost appropriately, but then the other one is just that organic growth within those services. So like optimizing the mix of products being sold. So one interesting thing is that like their fuel, as an example, they kind of break it down into fuel and then merchandise and services. So it's a 75% to 25% split on revenue. Fuel to merchandise and service, but then when you look at the gross profit, it's 50-50 or so at this point. So it's really ramped up. So they're obviously focusing on getting more bang for your buck. When you're selling something, you really want higher gross profits and like high turnover on that asset too, like better inventory management essentially. So that was kind of the interesting thing. So looking forward, one of the part of the pitch would be like, okay, what about going forward? It's done historically really well. Going forward, they've really been focused on like, as I mentioned, kind of organic growth. So better offerings in store. So that's where a lot of their capital is going to go. But recently, they've also identified that prices for acquisitions have also started to come down to better levels. So I think right now they've got lots of room on their balance sheet in terms of like levering up the debt a little bit more. They kind of have a target of debt to equity of 2.25 or something like that, and they're 1.5. So they've got lots of room to. I think right now they have just 800 and something million in cash, something like that.
Mhm.
So they have basically lots of room, lots of cash to go after some acquisitions, kind of opportunistically. So a lot of times the acquisitions will be this part of the business someone else has. It would be kind of an ugly duckling part of the business, and they're just the business is not focused on operating and optimizing that part of the business. So often, Kushai will come in and say, "Well, that is our business, so let's take that off your hands for you. You don't have to worry about it anymore." And really, they'll go in, like they'll approve it. They'll get their systems. They've got really good scale, so things like fuel margin, they can offer better pricing and better margin than fuel, as an example. So yeah, that was kind of the pitch there. Like there's internationally, there's still plenty of room for growth. It's still a fairly fragmented industry, even in the U.S. Still room for growth there. So I think even though they've become kind of a mature global business at this point, there's still quite a bit of opportunity for growth overall. And then couple that with pretty good capital allocation. I think they bought a couple $2 billion in shares back last year, something like that.
Nice.
And they continue to grow the dividends. So like, I think it's it's not super cheap right now, but I think it's something like a 20 PE or 18 or something. But they don't expect like a ton of growth over the next couple of years. But couple that with good capital allocation, and I think you do okay from here. As long as you're willing to kind of hold through some of the ups and downs. Like the business can be a little bit like shaky from year to year. Like it has some down years, but overall, like it's pretty resilient business. If you look at 2008, like during that crisis, they basically shrugged it off. It didn't really affect their business. People gotta get to where they need to go, and they're selling convenience, right? They're not necessarily selling gas. They're selling convenience. That's what they're after. So they've got a pretty good customer base for that.
Yeah.
So that's kind of that's the high level pitch anyway.
Nice. Yeah, that sounds good. There's a couple things that I would maybe not so much consider for the business itself, although I do think it could affect them down the road. But one thing I wonder with this company is does it follow sort of this cyclicality of oil and commodities and gasoline demand that way? Like I wonder if you put the chart beside a oil company, if it would sort of flow, because they do sell gas, right? I wonder.
So they're
because their price margins
they're basically taking a margin,
move
so
up and down, right?
As the price of, let's say, crude goes up and down, I don't know how closely gasoline really follows that, to be honest. Like I'm sure it is correlated to some extent. Obviously, it's the input, but the business in reality, like it is, it's a margin business. So like they're gonna be able to extract a certain margin. I think realistically, like a stable price of oil is probably ideal.
Yeah,
because then they can plan,
sure.
their logistics can kind of keep up. But they're really a margin business, so they're not going to be like exposed to like ups and downs as much. Now, what will hurt them, because they're a margin business, like as the price overall goes up for gas, volumes will be affected to some extent, like those discretionary kind of trips and driving and things like that. So as the overall economy kind of does well, people are out there, they're driving around, there's more trucks on the road, there's people taking trips, so they're exposed to the broader economy probably a little bit more than just the price of oil. The other thing about the price of oil would probably be like a second order effect. So like as prices go up for gas, people will still buy gas and they will still get a reasonable margin. The margin might get squeezed a little bit. The effect they've mentioned before too, I think, is that the more people have to pay to put gas in their car, the less they have in their wallet to go inside and buy the other
Also
merchandise
true.
and
Also
services.
true. Yeah, you're not
So
buying Doritos if you
they
just drop
want,
$200.
they really want the consumer to have a nice fat wallet to be able to
Yeah.
go and buy like the $5 Gatorade or
Mhm.
whatever it is, right? Like the other purchases is where they make a nice profit. So overall, I guess stable, reasonable price for gas is really what they're after. Would benefit their business the most.
Yeah, like I don't think their margins will get squeezed because they'll just adjust the price. It'd be the sale volume.
Yeah, I
Right,
think temporarily, like they'll take hits on their margin for sure. But yeah, overall, like in the longer medium term, even if gasoline kind of goes up, they'll do fine. But as the wallet gets kind of a little thinner,
Yeah,
people
then you're not
maybe-
buying the extras.
yeah,
Yeah,
their
that's
hot dogs
definitely.
and stuff are not going to do as well.
Yeah, that's a really good point. Yeah.
Fun trivia: they sell more hot dogs than Costco.
Oh well, there you go.
So, all you
Are they
Costco
$1
lovers-
though?
I don't think they're $1.
So even better.
Even better.
Yeah. So then I follow oil pretty closely, and right now there's a lot of talk about a supply deficit, and it's oil is what it is. You
Mhm.
never know what's going to happen, but I suppose that would be a risk to them is the price and also impending recessions and those kind of things, right?
Yeah.
Like mega macro stuff.
Yeah.
But super hard to predict that kind of thing. Another sort of like big picture view you could have on it is the impact of EVs for these guys.
Yeah.
And I'm not somebody that believes that EVs are going to take over the planet anytime soon. I think we're going to have gassers at least for the next 20, 30 years, especially like cars being built now are going to live for 20 years.
That transition's going to take a long time.
You'll sell them to your kids, or college kids will be driving gassers. They'll be able to afford the EVs or Teslas. So like, I think that there'll still be a lot. What's the gasoline price going to be? I don't know, but have they talked anything about putting chargers in to get people in to buy the merch?
Yeah, they've for sure. So they had a test store in I think it's 2020. They opened up in Norway, and it's been quite successful. And so a lot of their Scandinavian offerings, like their stores, have these chargers installed. So I think they're concentrating their efforts there for now. But I know that I think it's the US and maybe Canada as well. They do have plans for, I think, next year to start having. Then I'm guessing they already have a few pilots out there to have some stores with chargers. I don't know the number off the top of my head, but they're moving in that direction for sure. I think they've been quite successful with the Norway offering. Now, one of the features of the business is that they're actually quite decentralized in that, like, they allow different regions to operate how that region, how that customer acts. So like the Norway, customer is probably not necessarily how North America is really going to work. Like, I don't think it's going to be one-to-one that way. And like you said, it might be, I do think longer term, like, it could impact the business. I also think that they've recognized this for quite a while now.
Yeah.
And they're doing a lot of things to like ramp up how they're going to adjust to that. So I think part of it is they're going to actually be focusing more on like the food offerings and things like that in a manner so that they can be proactive about it. I think you kind of think about it like if all you're offering is like a few snacks and somebody looking at you behind the counter, then that's not a very attractive offering for someone who has to kind of sit around for 10, 20 minutes. But I think a lot of the movement towards like the fresh food offerings and things like that is a good sign. And I know that some of their stores have started to focus also on like just purely convenience store locations. So like smaller stores in like inner city type location, like more urban areas that way. So
that's cool. Yeah, like I was actually gonna.
It is a risk, I think, though.
I was gonna actually bring that up and say, do you think that the transition to fresh foods and like the initiative that they're taking is in anticipation to EVs? Because people do. It's not like you gotta fill your tank and leave. You got to sit around for however long. I don't know how long these superchargers take.
I don't know what triggered it, to be honest. I don't know that they even say that that's what triggered it.
Like I didn't know if in the conference call or something like that they maybe brought it up like, oh, people are going to take more to charge. We're going to offer
Yeah.
them something to
Like
do.
these better offerings with fresh fast food and different things like that.
Mhm.
That's been an initiative for a few years, so it's hard for me to say for sure that that's what stemmed it, or if it's just like an organic growth initiative to really like
Yeah.
attract better customer loyalty that way.
Yeah.
Think about people's morning commute or something like that. If you're one of those people that stops in somewhere to grab a breakfast sandwich and a coffee on the way to work type of thing, I think that's part of what they're after as well.
There's also like probably like a ton of like high schoolers that go in there and get like a slice or whatever.
It's a fun spot too. Like,
yeah,
I'm sure you've been into some of them. They're fun stores. Like, they have unique food offerings.
Yeah.
They have unique products, different packaging, just stuff like that. Historically, like the tobacco and liquor and things like that has scratch tickets and lottery tickets and things.
Yeah.
That's been the other thing that really gets people in to buy things.
Mhm.
And I think they've recognized that they don't want to just be fully, reliant on that part of it. So
yeah. Probably best to have a couple offerings other than smokes and and gambling. But those businesses also do well. So
they're pretty good. Yeah,
that's it is what it is there as well. And I wonder, do you know like how much have you looked into their the perks that they're offering? Like, are these do they seem reasonable to you? Like something you'd be interested in?
I haven't looked too much in detail, to be honest, at them. I know that I think they're kind of regional offerings. So
okay.
I know that they're really like experimenting in different areas to try to see like what works for different customers and for different experiences. And I think it'll end up being like a regional type of thing. Probably as they figure out like what areas of the world really appreciates that type of thing. And they also probably would benefit, like, because of their scale, they can offer different things in different places and see like, oh, this tends to work. Let's see if it works over here.
Yeah.
So that's the other part.
Yeah, like one of the best performing stocks that I bought as an individual company is Loblaws.
Yeah.
And I think I bought them like 3-4 years ago. But one of the main reasons, what triggered me to start looking into them was their PC points.
Right.
Because I got a PC MasterCard, and I was like, this is great. I'm getting all these points, and like I can just knock off $100 off my groceries. Like, everybody's gonna love this, and they've done really well with that initiative. And
they're white. You tie it to the white label products that they offer.
Yeah, you buy their products, you get more points, and like people love that stuff.
And that's interesting that you bring that up, because they're starting to offer a lot more of that kind of like white label products as well in their stores. The Circle K brand is starting to take on a little bit more momentum because of those products, and I think that makes like loyalty memberships and different things like that. Like, it all of a sudden makes that something that might make sense, because you can not only attract like repeat business, but you can sell potentially higher margin products. To those people.
Yeah, for sure. I know it definitely works with Loblaws, because
I just heard that they are starting to offer some white label wine in some of their stores.
Circle K.
Circle K wine. So if you want some Circle K wine, it's coming.
Yeah, go get the Circle K wine and the Circle K smokes.
I'm not sure if I'm sold on the Circle K wine yet, but
I mean,
we'll see. I'll try it.
I've had the no name beer. It's okay.
Yeah.
But yeah, that's interesting. I think that it's like Loblaws, certainly. Canadian Tire's been doing this forever.
Yeah.
With crappy tire money.
Yeah.
But
it's worked out pretty well for them.
Well, yeah. Now Loblaws is doing the same thing, and with their MasterCard, like now they get all that data that they probably sell or whatever, and it's just like they got a credit card business, and it's just maybe you'll see a Circle K credit card.
Yeah.
That you can knock points off your gas, which people are going to.
There might already be one there.
Honestly. Yeah, they very well could be, and if there isn't, they should.
There you go.
Yeah. I guess the last thing I would probably say about Circle K is, do you know where most of their locations are? Like, are these primo locations downtown Toronto, or are they like kind of the outskirts and those sort of like fuel up zones and stuff?
I don't think there's like there's some definitely really good locations. I don't think for the most part they're like downtown type locations, but
yeah, I'm just wondering what their like real estate risk sort of.
Yeah. don't think that's a huge risk because they're probably not like super expensive type real estate. Like I don't think gas stations in general are
Yeah, it's not
sought after real estate.
Yeah, it's not like a commercial real estate building. It's more
Right.
like just like a gas station.
I think it's a tough resale too, just because like if it's a gas station, then there's a lot of environmental things to consider if you're going to build anything on it again after.
Yeah.
But I don't know. I'm not 100% sure. It's a good question.
Mm-hmm.
Yeah. They're definitely not like the Dollar General type of thing where they're all outside the city type of thing. I don't know if you know their story, but like,
no, I didn't know that.
They're more like a rural footprint, so that's part of their strategy. Like Tractor Supply, I believe, it's kind of like that too.
Mm-hmm. That's interesting.
As far as I know, they don't have like a strategy that's like this is how we're gonna situate them. I think they just go after good locations,
like find the good deals and buy those places.
And like a good deal for a gas station, or sorry, a good location for a gas station may not be like prime real estate necessarily. Right?
It doesn't need to be.
It doesn't necessarily line up with like prime real estate. Yeah.
It is interesting with the food thing because I've been seeing that like all over. Like our place has like samosas now.
Yeah.
And I'm just like, when did gas stations start being restaurants?
That's right. Yeah.
Like it's only like the last like 5 years.
They have some pretty interesting stuff. Yeah.
Yeah.
And there's big stores and they're all these ones are new, I guess, around where we are, but like even the ones I've been other places, like they're always like well lit, they're relatively clean. They're stocked. People are attentive, like the workers are kind of know what they're doing. Like,
do you think that there's a little bit of a, I don't know, hesitation from people to go to those like restaurants and gas stations? Like, I don't know, I'll just go to like the Timmy's just because that's what I'm used to.
Yeah.
But I've never actually got
for
food in a gas station.
Yeah.
Like,
perhaps
not like fresh food. I just wonder if it could be a growth barrier for them. Like say people aren't used to it, but like over time, maybe, like a bit of a stigma maybe, but like just, I think it's more just like, it's not, you're not used to it. Like you expect a convenience store and then they're selling you pizza.
Yeah.
But like, I wonder if that could be beneficial to them as people start to accept and get used to that.
It might be. I think the benefit they have is that like their locations are generally more convenient than say, oh, I'm gonna go. Maybe Tim Hortons is generally pretty convenient locations, but
usually they're side by side.
Yeah, fair enough. Yeah, I don't know. I think as soon as you get like a certain customer that's going to be like repeat, and that's just part of their habit, then it becomes a thing.
Definitely for like coffee or breakfast sandwiches or something, like you're walking in there anyways.
If you're like, I think if you're going somewhere and you're like, hey, how often do you have to get gas when you're going to work? Basically, it happens, and so you're like, okay, well, I'm here anyway. Let me just grab my coffee and breakfast sandwich or whatever it is.
I think another growth area for these guys would be cannabis too. Do you know what they're doing with cannabis? I know in Canada are legal states.
They have they own some big stake in I can't remember the name, to be honest. A cannabis retailer essentially. So we've got essentially an equity partnership, I believe, with them, and so they're going to partake in that as well. Yeah,
like I remember seeing something. Canopy did something with them. For sure, they're selling their BioSteel out of there, but they're also, I think, they're selling maybe like vapes or something.
Yeah, potentially.
I think they're doing like vapes and stuff. I mean, they already.
I don't think it's a huge part of their business yet, but it's potentially a good growth from a small base to good growth there.
Especially a lot of them are 24/7. Yeah.
Yeah, like that's the other advantage over like some of these other food places too. Like a lot of them are either 24/7 or very close to it. Yeah, super convenient for late night, early morning, all those kinds of things.
Some post-bar samosas.
Yeah, there you
go. Do you know they sell the food all through the night?
I think it probably depends on location, I guess.
Yeah, probably does.
I think for the most part they would.
Toronto, I'm assuming they probably do, and whatever.
Yeah, I mean, it's not like they're always preparing it all the time. It's like one of those things where it's like it was made and now it's available for a certain amount of time, I guess. Yeah. So I would think that they're generally pretty well stocked.
Cool, man.
Yeah.
Well, that's awesome. I'll take a look at that, and if anybody's watching and they have some stocks they want to let us know about or whatever, we can take a look at those as well. But I think that's good for
it was
tonight.
fun, Joe. Yeah,
we'll do it again.
Yeah.
Hopefully I put some cracks in your theory that
Yeah.
you need to.
Yeah.
need
No, you
to
have
mop up.
some good questions. Yeah.
Yeah,
For sure.
I actually really like the idea of a convenience store growth play.
Yeah.
And it's, Starbucks is a good example of what can happen when you bring that kind of an idea into Asia.
Yeah. Yeah, that's true. Yeah.
Because Starbucks is like growing like crazy in
I think
China.
I think Asia's a tough nut to crack.
Yeah, but
So
I would have
they're
to.
being cautious about it, but it's a high potential.
I would have to think that something like Circle K could do well over there.
Potentially, yeah.
Fill it with whatever the
Yeah.
people want and just,
Yeah.
gas up their vehicles.
I suspect there'll be like a lot of the Asian places they've done like some licensing agreements, so I think people might do stuff like that in these areas that they're not really as familiar in terms of the culture and how to operate a business in those areas. So
Yeah,
we'll see if that's what they do.
How to deal with the officials.
Yeah, yeah.
Over in China, man.
Yeah,
it's probably tough. You gotta find.
I imagine.
You got to talk to the right people to get your store in the right place and stuff. I mean, it's like that everywhere, but yeah, cool, man.
Yeah.
Well, we'll cap it off there. And thanks to anyone who's watching.
Yeah.
Have a good night.
Cheers.
There we go. And that.